Breaking news shakes the luxury world. A company once synonymous with prestige, elegance, and billion-dollar glamour is now navigating one of the most complex restructurings in recent retail history.
Saks Fifth Avenue has just announced it will close its Union Square store on May 10th.
Saks Global, the company that owns Neiman Marcus, could be headed toward bankruptcy.
Saks Fifth Avenue says they're closing their store on Post Street next month.
Saks has been struggling almost from jump from as soon as they completed this merger with Neiman Marcus, and
they were institutions, symbols of aspiration, destinations where shoppers experienced fashion at its pinnacle. Windows glittered like jewels, floors echoed with footsteps of the well-heeled, racks held the world's most coveted names in luxury fashion. But beneath the surface of glitter and velvet, a financial storm had been brewing. Debt, delayed payments, and strategic maneuvers threatened to reshape the future of these iconic brands. And the center of this storm is Saks Global. Chapter 1. The Origins of Saks Fifth Avenue. Founded in 1924, Saks Fifth Avenue began as a vision for sophistication in the heart of Manhattan. Horace Saks and Bernard Gimble merged their retail expertise and purchased prime real estate on Upper Fifth Avenue. It was a bold gamble, turning a primarily residential street into a luxury destination. Saks quickly established a reputation for exceptional service and curated fashion. Following Horace Saks's untimely death in 1926, leadership passed to Adam Gimble, who expanded Saks westward. By 1969, Saks Fifth Avenue had become a dominant force in luxury retail. Throughout the 20th century, Saks continued expanding through strategic acquisitions, first by Battis in 1973, later by Investcorp and international investors in 1990. The 1994 purchase of I. Magnin stores strengthened its West Coast presence, opening locations in Beverly Hills, San Diego, Phoenix, and San Francisco. By the mid-1990s, Saks became a public company, merged with profits in 1998, and by the early 2000s, it generated $6 billion in annual revenue with healthy gross margins, though net margins were barely breaking even. Chapter 2. Acquisition by Hudson's Bay Company. In 2013, Hudson's Bay Company, HBC, one of North America's oldest corporations, acquired Saks Incorporated for $2.9 billion in cash. This transaction was financed through a combination of debt, including a $950 million asset-based loan, a $2 billion senior secured term loan, and a $300 million junior secured term loan, alongside $1 billion in equity. At the time, Saks generated $3.2 billion in revenue with a 40% gross margin. HBC aimed to leverage its expertise in retail and real estate to grow the brand. By 2017, HBC faced mounting debt and declining sales. Roan Capital intervened with a $500 million equity investment and the acquisition of HBC's Lord & Taylor Fifth Avenue building, injecting liquidity and governance oversight. Yet, even with these measures, the seeds of financial strain remained. Chapter 3. Precursor Turbulence. Luxury retail was already in decline. Since 2022, U.S. spending on luxury goods had fallen for 10 consecutive quarters. Rising prices, decreasing discretionary income, and shifts toward digital shopping reshaped the market. Both Neiman Marcus and HBC had recently emerged from Chapter 11 bankruptcy, raising questions about long-term viability. NMG had filed in May 2020 following over-leveraged buyouts, stagnant revenues, and shifting consumer preferences. HBC's 2025 Canadian bankruptcy reflected post-pandemic declines in foot traffic and discretionary spending. Even Saks experienced significant losses in 2024, exceeding $100 million, alongside chronic vendor payment delays. The stage was set for a high-risk consolidation. Chapter 4. Formation of Saks Global. December 2024 marked the birth of Saks Global. HBC acquired Neiman Marcus Group and consolidated multiple banners: Saks Fifth Avenue, Saks Off Fifth, Neiman Marcus Last Call, and Bergdorf Goodman into one entity. Amazon and Salesforce contributed minority equity stakes to advance digital and e-commerce capabilities, while Roan Capital, NRDC Equity Partners, and Insight Partners retained their positions. The combined company now operated around 180 stores across 10 million square feet and 5 distinct e-commerce platforms. Projected revenue for 2025 stood at $8 billion, with assets valued at $7 billion, including intellectual property and real estate. The acquisition aimed to streamline overlapping expenses and strengthen supplier bargaining power. Debt financing included $2.2 billion in 11% senior secured notes due 2029, a $1.8 billion, and additional equity contributions. Chapter 5. Immediate post-acquisition challenges. Optimism quickly faded. Creditors' confidence eroded. The price of Saks 2029 notes collapsed from 97 cents to 35 cents on the dollar. Challenges emerged in two key buckets: near-term liquidity headwinds and structural vulnerabilities in bond indentures. Near-term liquidity headwinds. Delayed vendor payments. Pre-existing DPO of 180 days extended further after acquisition. Vendors faced up to 12 installments for $1.3 billion in accounts payable, leaving some to wait years for payment. Store closures. Iconic locations, including the 100-year-old Neiman Marcus Dallas flagship and Union Square San Francisco, shuttered or shifted to appointment only. Multiple facilities closed, eroding creditor confidence. June 2025. Interest payment. Limited liquidity and declining borrowing capacity heightened fears of default on the $120 million 2029 note coupon. Loose bond indentures and collateral movement. Saks moved intellectual property into non-guarantor subsidiaries in January 2025, removing collateral from secured creditors. Real estate, including the NYC flagship, remained in unrestricted subsidiaries, leaving lenders with weaker claims. Chapter 6. June 2025. Out-of-court restructuring. With liquidity under pressure, Saks sought alternative financing. In May 2025, a $350 million ABL from SLR Credit Solutions was arranged. Soon after, a majority group of noteholders, advised by Lazard and Paul Weiss, proposed a superior $600 million transaction, $400 million FILO facility, first in, last out, $200 million additional commitments contingent on certain conditions. The deal allowed majority creditors to exchange existing debt into new, higher priority bonds. Minority creditors faced subordinated positions if they did not participate, a coercive uptier exchange. Saks paid the June interest on time, restoring short-term liquidity to $850 million. The move was a temporary lifeline, not a cure. Chapter 7. The Fall of Saks Global. Despite mid-2025 efforts to stabilize operations through temporary financing and debt exchanges, Saks Global could not turn the tide. Vendor payments remained delayed, inventory shortages persisted, iconic stores continued to close or shift to limited operations. The company struggled under the weight of billions in debt, and sales failed to rebound. By early 2026, the combination of over-leveraging, operational challenges, and declining luxury spending proved insurmountable. Chapter 8. Chapter 11. Bankruptcy filing. In January 2026, Saks Global officially filed for Chapter 11 bankruptcy protection in the U.S. Bankruptcy Court. The filings cited overwhelming debt obligations and inability to meet payments following the consolidation of Saks Fifth Avenue, Neiman Marcus, and Bergdorf Goodman. A new CEO was appointed to guide the restructuring, and approximately $1.75 billion of debtor-in-possession financing was secured to allow stores and e-commerce platforms to remain open during the proceedings. Many Saks Off Fifth and Neiman Marcus Last Call outlets were closed or liquidated, while flagship stores continued operations under court supervision. The company also began reorganizing its real estate and intellectual property holdings to stabilize operations. Chapter 9. Legacy and Lessons. The story of Saks Global illustrates that even the most iconic luxury brands are not immune to financial mismanagement, operational misalignment, and changing consumer behavior. Temporary liquidity measures can delay collapse, but they cannot replace a sustainable business model. Over-leveraging and slow adaptation to digital and market shifts left the company exposed. Saks Global's bankruptcy is a cautionary tale. Prestige and ambition cannot offset structural vulnerabilities, and the future belongs to those who adapt swiftly and strategically. End. Luxury in transition. From glittering windows and celebrated flagship stores to bankruptcy proceedings, Saks Global's journey reminds us that luxury is fragile, debt is unforgiving, and survival depends on adaptation. The empire may continue to operate under restructuring, but the path forward will test the limits of even the most storied of luxury names. Only time will tell if it can reclaim its former glory.